turn it over to you for the panel.
Terrific. Thanks, everybody. You got sort of a treat this morning. Hopefully this is interesting to you. We've got three panelists. Jackie Mazur is the CFP, a certified financial planner, as well as the president of Guide My Finances. I believe that's her company. She founded it. John O'Reilly is the founder and owner of O'Reilly Wealth Advisors. And I am a CFP and wealth advisor for WWM Financial here in Carlsbad. So what we're going to focus on this morning, there's a broad category of things we could talk about. We're going to talk about retirement planning and specifically what tips and tricks we can offer to this audience this morning. We don't have a lot of time, but I'm going to ask a few questions. If you want to ask questions, I don't know, John, if we have another way to do this, but just type them into the chat. Is that the most efficient way to do it? Or just unmute yourself and dive in. I don't really care.
I think we should just unmute and dive in. And one thing I wanted to mention is that we've moved these presentations to the end of the meeting in case they run over. So it could run over. Just letting you know.
And if you can't stay, you can't stay. So no problem. Just leave when you need to.
It will be recorded. It will be recorded and end up on the chamber website.
Okay, perfect. So with that, I'm not going to do long introductions of everybody. Reach out to one of us if you have additional questions or detailed questions about your specific situation. These are going to be more broad in nature, but I'm going to start off with some IRA and 401k basics, because IRAs, 401ks are the typical way many professionals, many people in business save for their retirement. So let me throw this out to Jackie and to John. Either one of you take this on, but why should an investor use a traditional IRA versus a Roth IRA? Kind of really quickly explain the differences. And I just realized I forgot to, so before we dive into that, I forgot to let each one of us give a quick slide overview. So Jackie, I think John, you've got the slides. So here we go. Jackie's going to talk about traditional versus Roth IRAs.
Perfect. So when you're saving for retirement, there's really two ways to do it. One is to take advantage of tax deductions today. The other is to have tax-free income available to you in retirement. So regardless of whether you have a business or not, IRAs are available to you as long as you have earned income. And there's, like I just mentioned, the two types. The traditional IRA is going to allow you to save money on taxes today. For every dollar that you put in, you're going to save whatever your tax rate is. So if you put in the $6,000 for the year, it'll be as if you didn't even make that $6,000. You're not going to pay taxes on the $6,000. As that money grows, it's going to grow tax deferred. But when you take it out in retirement, all of it's going to be taxable as income. So if you need $50,000 a year, you take $50,000 out of that IRA, your income will be taxed as if it's $50,000 that year. The Roth IRA works in the opposite way. You don't get a tax benefit today. So if you save $6,000, it's just as if you saved $6,000 into a savings account from a tax perspective. You are not paying extra taxes on that money. You're just not getting a tax deduction. But as that money grows, it's going to grow tax-free. And when you take it out in retirement, none of it is taxable. So if you think about that scenario I just gave you, if you need $50,000 a year of income and that $50,000 is taxable, you're actually going to need to take $65,000 to $70,000 out of your retirement account because you'll have $50,000 to spend. The other $20,000 is going to go to taxes. With the Roth IRA, you can just take out $50,000 and none of it's taxable. So it gives you the ability to have your retirement assets go a little bit further because you don't have to account for taxes while you're living on a fixed income. I know that we're a little short on time, so just two other quick things. With the traditional IRA, you are forced to take money out when you're 72 through something called a required minimum distribution. The Roth IRAs don't require that. You can leave the money in there as long as you want. You could take what you want. You're not required to take distributions. The one caveat with the Roth IRA is that there are some income limitations. So you can't make over, I think it's $180,000 this year as a single. I think it's around $200 now for a married couple. You basically are priced out of it. You have to be at a certain tax level or certain income level in order to qualify for the Roth. So I'm going to hand it over for the next slide just so we can keep moving through this and we can get to the panel.
Perfect. Thank you, Jackie. So I'll take this one on. So some of you may be aware of this. I'm guessing most of you are not. If you're a small business person, the state of California is, let me say, encouraging, some would say imposing, a new mandate on companies to try to get more companies to offer retirement plans through the employer to their employees. And so as of a couple days ago, actually, if you have more than 100 employees, you are supposed to have, by state mandate, you're supposed to have a retirement plan available for your employees now. So for example, if I jump down to the bottom two bullets, if you already have a 401k, or you have some other form of retirement plan, like a defined benefit plan, you're good to go. You don't have to offer this thing called CalSavers, which I'm going to talk about in a minute. CalSavers is a new program available from the state. If, on the other hand, you don't have any retirement plan currently in place, you are supposed to put one in place. And you have the option of putting a conventional, say, 401k plan in place, and there are many flavors of those, or you can put CalSavers in place. What is CalSavers? Well, it's a brand new state-operated plan. It's available for companies right now. It uses, Jackie just went through the Roth versus the traditional IRA. It uses the Roth version, the after-tax version of an account for the employees. It's a portable account, meaning they can move it if they change from employer A to employer B. They can take it with them. There are no employer fees to participate in this plan, and employers are not allowed to match any of the contributions. Companies enroll the employees. They submit the payroll deductions. Employees are going to be auto-enrolled after 30 days when this plan goes in place. They can opt out if they choose to. They can change their deferral percentage and so on. The investment options are set by the state. So if you're an employer and you want to offer one of these plans, that's fine, but you don't have any options on the investment options. They're mandated. You can't add them, you can't subtract them. They are what they are. And more specifically, there's a target date fund, there's a stock fund, there's a bond fund, there's a sustainable, or otherwise known as ESG, which stands for Environmental, Social, and Governance Balance Fund, and then there's a money market fund. So there's a very limited set of investment options, but they're there. And most of the options are offered through State Street Global Advisors, who's the originator of the ETF, the Exchange Traded Fund. The first Exchange Traded Fund was the SPDR, SPDR. And so, so in a nutshell, that's what CalSavers is. It's a new retirement plan. But again, if you're an employer, you have more than 100 employees, if you are already offering a retirement plan to your employees, you do not have to adopt CalSavers. You're not required to. But you are required to have some sort of retirement plan in place. Let's see. The other deadlines that might be important to a few of you on this call are, if you're more than 50 employees, your mandate, your date of implementation is by June 30th of next year. And if you're 5 employees or less, or greater, excuse me, then June 30th of 2022, you are mandated by the state to have a retirement plan in place for your employees. So lots more I could say about this. I'm going to leave it there and jump to John O'Reilly to talk about his plan available through the chamber.
Let me do a sound check. Can you hear me, Scott?
Yes.
Thank you. All right, next slide, please. All right, so the Carlsbad Chamber is now offering a multiple employer plan, also referred to as an aggregation plan. Imagine if all the businesses around Carlsbad needed about 100,000 pencils a year. So the Carlsbad Chamber says, you know what, we're going to buy 100,000 pencils and get a great deal, and then we'll, you can buy them from us at a really low price. Someone may need to mute. And but now imagine that the chamber said, well, across the nation, there's other chambers and other people that are buying pencils, and they buy 50 million pencils. You know what? We're going to tap into that 50 million pencils and get an even lower price and then offer that to our members. That's essentially what a multiple employer plan is. It's a gigantic plan with tens of thousands of companies and around 2 billion of assets for the one that the chamber is in, which is one of the largest ones available in the country today. You get such a low price that an extra service is added in. An assistant is built into the plan that takes care of the day-to-day minutia. There's a fancy name for this person, an ERISA 316 administrative fiduciary, which you don't need to know. Just think of you got a little part-time person that's helping you deal with the day-to-day minutia of the plan, which is great for a small business owner. And one of the reasons why the chamber is doing this is because of the CalSavers mandate that Scott just talked about. Now, the assistant takes on the day-to-day, month-to-month, year-to-year minutia. They even sign something called the Form 5500 that has to be submitted every year. But they not only take care of those duties, they take on the liability for those duties. So it's a world-class plan, low liability, low price, less time to oversee. There's actually another extra assistant called an ERISA 338 investment fiduciary. They take on the liability of putting the funds in place and monitoring them. So this is really a plug and play plan that's very low cost, low liability, and a top-notch plan. You also keep, let's say you had an existing 401k plan, you wanted to move it over. You keep your current plan's unique features. We call it the personality of the plan. So the eligibility rules, the vesting rules, matching features, and so forth. You can keep those all unique to your company. So, sometimes too good to be true is actually true. And this is one of those times. Now, these plans have been around a long time, and that's why this plan is so large. So if you run into somebody that says, hey, we just started a new multiple employer plan, that's probably not the plan you want to be in, because it's going to take years to get to the size to give you all the benefits that you want. Now, the Secure Act that was passed December of 19 loosened the rules slightly to make these plans even a little bit better. Now, the chamber benefits by offering this plan. There's a 0.05%, and to give you a feel for that, that might be about 1/20th of the cost of a plan. So this could be huge for the chamber over a long period of time. If they get enough plans coming in, it would actually create a small income stream to the chamber that would give them stability and allow, provide even better benefits and so forth. So you can help your company, help your employees, help your chamber, help your community. And this is a great alternative to CalSavers. It's perfect for existing or startup plans. That's what I got.
Thank you, John. I would just add to your help you. The other person you're helping is yourself. So I think everybody on this session probably knows this, but I mean, if you don't save for your own retirement, let's be honest, nobody's going to do it for you. And if anybody thinks Social Security is going to be a fun way to enjoy your retirement, you might want to think again, because it's not. It's just not enough money. It's not intended to be a full retirement plan. So with that in mind, let me throw the question I was starting to throw out there. Let me throw it more specifically at Jackie. Since Jackie, you talked about the differences between the traditional and the Roth IRA and saving for retirement. What do you recommend for your clients? Why would you recommend a Roth IRA versus a traditional IRA for your clients?
Yeah, so in general, I think that Roth contributions make the most sense based on our low tax position right now. Tax brackets are the lowest that they've been really in years. And so as a result, getting that tax deduction isn't worth quite as much as it was before. One of the things I do like to focus on, though, is that a lot of people don't qualify for the Roth IRA. And as business owners, you have the ability to utilize something called a Roth 401k, where through your 401k plan, you can contribute in that same Roth fashion, and there's no income limitation. So you can probably tell by the way that I presented initially, I don't think there's anything better than tax-free growth, especially having tax-free dollars in retirement. It's just going to go a lot further for you. When clients are in the highest tax bracket today, it may make sense to get the tax deduction, especially if they think that down the line they might need less money. But generally speaking, the Roth dollars are a beneficial way to contribute, at least today, before tax rates go up, to have that tax-free money coming to you when you're living on a fixed income just off of your savings.
That's perfect. Thank you. I'm going to throw one more at you, Jackie, and then I'm going to bring John in for the next question. But
can I interrupt?
Sure. Go ahead.
So great answer, Jackie. And then also, not only the income limitation of how much money you make, but also the cool thing about the Roth 401k is that you can contribute, a lot more than
Right.
you can, including Cal Savers has the same limitation as just an individual contributing to the Roth IRA. So if you put a Roth option into your 401k plan, now you can put in tons of money in there. I'm sorry, go ahead, Scott.
No, that's a perfect segue. So what I was going to say is, and you guys can both opine on this, if somebody is working for a company that does offer some sort of retirement plan, let's say it's a 401k, and let's just say hypothetically they match, so their employer matches up to 3%, up to 5%, whatever the number is, then what would your advice to your clients be in terms of making a contribution to, for example, a Roth IRA, as Jackie was talking about, versus the 401k?
If you have an employer plan, you should be utilizing your employer plan first, in my opinion. In fact, if you have a plan offered through work and you try to contribute to a traditional IRA, it's probably not going to even be tax deductible, because there's an IRS rule that says that if you're offered a plan through your work, you can't get the tax deductibility from an IRA as well. With your 401k plan, deciding how to contribute is going to depend on the investment options available, the fees within the plan, whether you have the option for Roth contributions, which today most plans do have. That's pretty much a standard today. And then really, how much can you afford to contribute? With a 401k plan, you can put away up to $19,500. And if you're over 50, another $6,500. With an IRA, you can only put away $6,000, and if you're over 50, $7,000. So unless you're already maxing out your 401k plan, you probably don't even need to look at the IRA, because of the tax. It just doesn't have as much flexibility and as much benefit to you. So I would say max out your 401k plan first. And as a general goal, even if your company's contributing a 3% match, really, if you want to ever retire, you need to put away at least 10% of your salary.
Excuse me, panelists, I want to break in and ask if anybody has to leave at 8:30, which is like 2 minutes away, and has a question that they'd like to ask, why don't you ask it now? As you were.
Okay. So great stuff, guys. I would just add one more thing, and that is, if for some reason you do think you want to use an IRA or a Roth IRA, and also contribute to your 401k, generally speaking, there are income limitations, but you can do that. But as Jackie says, I also prefer the employer plan, but as a minimum, please take advantage of that match. If they're matching 3% or 5%, at least contribute that much to your 401k so that you get that match, because that's free money. I realize you don't get to enjoy it for a few years, but that's free money. Please take it. The next question is more in the retirement planning realm. So, and Jackie started to answer this, but I'm going to throw it out to let John have the first shot at this one, and then Jackie, you can chime in here. But how much do people need to put aside to save for their retirement? What target do you suggest?
Well, what you shouldn't do is take targets that you see in a presentation like this. What you should do is actually do financial planning and actually do a financial projection to, figure out what you want to have in retirement, what you have now, and then you put it all into the big machine, and it tells you how much you should save. But I'd say for most people, you're probably not saving enough. More than 10% would be a good starting place. But everybody's different. And I also wanted to say that on the 401k, if you are fortunate enough to have one, get help with the investing. There should be an advisor on the plan, but if you have a financial planner, like Scott or Jackie, you should go to them and say, here's a list of all my funds, and their ticker symbols. Tell me how I should put my money into my plan.
Absolutely. I completely agree. And when it comes to how much you should save, it comes down to how much you're spending, what your mortgage payoff goals are. There's a lot of different factors. When you run those calculators online, they have no idea what your situation is. So it's a very general number that may or may not be relevant at all. So just like a lot of different financial advice, it's going to be different between one person, another person, depending on how much they earn and how much they spend and when they want to retire, if they want to retire, if they have a business that they can sell. So it's very customized. As a general rule, I would say for every $50,000 of income that you need in retirement, you need to have about $1.2 million saved. So if you only need $50,000 a year inflated over time, you need to have at least $1.2 million saved for retirement in order to generate that $50,000. If you need 100,000, you need about 2.4 million.
Yeah,
Again, really general rule, but at least gives you some sort of a basis.
yeah, which was going to be my next topic, which is the 4% rule. Before I jump to that, let me, excuse me, let me throw in one other little goodie, and that is there's a lot of retirement planning calculators online. If you want to use those, that's fine. You can put in some information. You can get back. It's going to show you a number or percentage that you should be saving for your retirement. That may get you in the ballpark, but to be honest, a lot of those calculators are so basic, it may not get you in the ballpark. If you really, really want a good estimate of how much you need to save, how much you need to plan for your retirement, honestly, I know it costs a little bit of money, but hire somebody. You know, and John, I think you do retirement plans as well. So it's, you know, whether he's called a CFP or not doesn't matter. He can do retirement planning as well, as can Jackie and I. So we have software tools available that the general public doesn't have access to. And that doesn't make us better than anybody, but it does make us more qualified to be able to help you identify how much you need to be putting aside. And trust me, those calculators are not as accurate as they should be. One other quick thought on it is a lot of it also depends. Jackie mentioned a few things. Those are all good, accurate things to worry about. One other thing is if you happen to be lucky enough, like you work for the government and you get a pension, and you are pretty confident that pension is going to be there when you retire, and there's some reason that I say that, but if that's the case, then you might not have to save as much as somebody that has no pension, and you're going to be funding your entire retirement from your portfolio plus a little bit of Social Security. So those are two very different situations. But the takeaway, if you don't take anything else away from this panel, listen to what Jackie said earlier. It's a 10 to 15% kind of a number for most of us. It's not a 1 or a 2 or 3% number. I have so many people that come to me and say, "Oh, I'm saving 3%. How am I doing?" And I hate to be the bearer of bad news, but that's just not enough. It's not going to get you there. Okay. Let me jump into the next topic, which is the 4% rule. So I don't know if John or Jackie want to take this on, but tell us the idea is if somebody saves $1 million, or Jackie used an example, $1.2 million, but if somebody saves a chunk of money and they're ready to retire, how much income can they turn that into in retirement comfortably without risking running out during their retirement period, which could be 25, 30, 35 years?
So that was really a general number. I don't run financial plans that way. I want to make sure that we're accounting for not just how much can we take each year, but what if circumstances happen? What if you or your spouse die prematurely? What if you have long-term care costs? All those types of things need to be factored into the decision of when you can retire and how much you should have. So there is a rule that says that you should only take 4% or 4.5% of your retirement funds each year. But if you're in bonds that are averaging 5%, you can take out more. It depends on your investment strategy, how your portfolio is doing, and what some of the other factors are to be able to determine how much you can take. So I think the one thing to really know is that those numbers or those rules are so generalized. They're a decent guide to help you at least figure out where you should start, but I would not base your entire plan on them. They're not including what ifs. They're not deciding if you want to leave money to your kids. They're not considering, if you have rental properties or other investments. So really it's going to be very different depending on your specific situation.
Yeah, and so for example, when you hear somebody or you read a paper, read something in the newspaper, it says the 4% rule, and you hear us talking about the 4% rule, recognize that's a rule of thumb. That's a broad estimate based. There's a lot of assumptions behind it, which those of us in the business understand. Many consumers won't understand. And so that number may or may not apply to you. And as Jackie says, I think probably all three of us use software to be able to handle all those other things. And it may very well not come out 4% for you. It may come out 2%. It may come out 6%. I don't know until we run our plan.
Sorry, Scott. I would say in general, also, if you're following any of the financial, celebrities like Susie Orman or Dave Ramsey or any of those people, one of the things that they have to do is cover their own liability and cover their own, butts for no better term. So when they're giving advice, they're giving the most conservative advice in the world. Because if they say, yes, you should have a mortgage while you're saving in order to take advantage of leverage, and somebody doesn't do that well, they're liable for it. But I would say that to say that you should pay off everything before saving is a disservice to that client who could be building their net worth more. So kind of along the same lines of that 4% rule, if you're reading that in the newspaper, I would be somewhat wary of some of the celebrity financial planners' advice, because they have to give advice to everybody, regardless of their financial situation, regardless of their sophistication and their ability to manage their finances. And so they're going to kind of follow the lowest common denominator and figure out, how do I not get sued, not what's going to be the best for you.
If I could chime in, Scott,
Sure.
I think a lot of what we're talking about here, we get onto these technical details, and so much of what we do is about psychology, and it's about sticking to something long term, gradually making progress over time. And if you think of personalities as spanning a spectrum from a full do-it-yourselfer to someone who's a full delegator, and if you know you're a full DIY do-it-yourselfer with your personal finances, and when you think of a show like Susie Orman or whatever, probably 80% of the people watching that show are do-it-yourselfers, and they're trying to figure out how to do it better on their own. But if you can somehow try to migrate yourself away from do-it-yourselfer and get to a trusted advisor like one of us, the so-called cost of working with us will be returned, like, I don't know how many times over, 100,000, whatever. So you really need someone to guide you, because so much of this is emotional. Investing is very emotional. People make, such critical mistakes when they get tied into the market, and they get tied into the emotion of the market going up and down. And they really need a coach, someone to stick with them over the long haul and help them to get expert advice, but then to actually act on the expert advice. Because just like thinking about physical fitness is not going to make you physically fit, same thing with personal finance. You actually got to execute it over time and have a really solid, nice person that can encourage you, not browbeat you, but encourage you to make, gradual progress over time. And I can tell, I've never worked with Scott as a financial advisor or Jackie, but I can tell just by talking with them that they are exactly that. They're people you can trust that can get a plan in front of you and help you execute it over time. And it really boils down to that. It's not as complex. You just want to have an expert working with you.
Yeah, thanks, John. Good stuff. So I'm going to do a quick reset and then jump into the next category. But the reset is, I'll go till about 8:45. That's a little more than 5 minutes away, and maybe a couple minutes beyond that. But we'll cut it off then. So we got a couple more topics real quick. So how do you guys recommend handling market downturns? What do you do for your clients, and what do you suggest for the people on this discussion today, this morning? Do you try to pull everything out of the market when you see a storm on the horizon? Do you just plow right through it and kind of stay the course? What do you recommend doing? What do you do for your clients?
Go ahead, Jackie.
So when I'm building out an investment recommendation for my clients, I'm considering the risk tolerance and that a financial storm is inevitable. The market works in cycles. It's never going to keep going up indefinitely. And so one of the things that we really need to do is determine what's the client's risk tolerance, how much rate of return do they need to earn, and how do we best build a suitable portfolio for that client. In March, when the market dropped 50%, my clients whose stomachs couldn't handle that, who were close to retirement and who were more conservative, their accounts were only down 10 to 15% because we had positioned their investments in advance in a more conservative allocation. My clients who have a longer timeline till retirement, or who want to shoot for that higher rate of return, who have a higher risk tolerance, their accounts dropped 50%, but they came right back, just like everything, with the market. So it's hard to answer that question across the board. It really depends on the client. I will tell you that if you try to time the market, it probably won't work out well. I have a client who last October asked me to sell a portion of their portfolio to cash, and they wanted to sell it all to cash. I talked them out of it. We ended up settling on that Warren Buffett had freed up about 23% of his portfolio to cash. I would free up 23% of their portfolio to cash as well. Here's the challenge. The market dropped 50%. I said, okay, it's time to invest. This is our time. Let's do it. They said, no way. I'm not putting my money back in the market. It's going to get worse. And as the market kept ticking up, I said, okay, we got to do it. We got to do it. We got to do it. No, 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 no. Now the market is higher than where it was in October. We sold to cash. We missed the opportunity completely to buy. You have to, if you're timing the market, and I can tell you there are a lot of clients with a ton of cash on the sidelines right now that sold out either before the drop or during the drop and are in a worse situation for not just staying invested. So I don't believe in trying to time the market, but I do think it's important to consider the risk tolerance of a client and not put somebody into a portfolio that's not going to be suitable for them.
Fantastic. I'm going to give you a chance, John, but I want to segue to that real quick and read you guys two quotes. So most of you have heard of the Oracle of Omaha that Jackie mentioned, Warren Buffett, a billionaire, self-made, made his own money through investing primarily. He says the only value of stock forecasters is to make fortune tellers look good. So I like that. But the second one's from Peter Lynch. Many of you may know Peter Lynch if you've got as many gray hairs as John and I do, but if you don't know Peter Lynch, he ran the Fidelity's Magellan Fund back in, I think it was the 80s. He had a really incredible run of successful returns, beating the S&P 500 for quite a number of years in a row. The reason that's so amazing is because most managers don't do that. They're not consistently beating the market, quote unquote. But anyway, Peter Lynch said this. He said, I can't recall ever having seen the name of a market timer on Forbes' annual list of the richest people in the world. If it were truly possible to predict corrections, you'd think somebody would have made millions by doing it. So even two of the brightest investors on the planet are telling you, be really, really careful if you think you're going to time the market successfully, because even the smartest people on the planet can't do it. So I'll let John have a chance if he wants to add anything to this discussion.
Yeah, we do a similar thing as Jackie, and I'm sure as Scott too, where we match up the risk tolerance of the portfolios to our clients, which includes, of course, their situation where they are in life. But when there's a big sudden drop like that, we simply rebalance our clients' portfolios because, when the stocks go way down, that's when they're actually less risky. The lower they go, the less risky they are. And so we take some out of the bonds and put them in the stocks. And if they were originally in say a 55% stock portfolio, and because the market dropped, it went down to 45, then we rebalance it back up to 55. So we were rebalancing in March, and it turns out we got lucky on the very last, the lowest point of it was March 23rd, I believe. And that's when we did our last rebalance. Now, rebalance doesn't mean you're moving the whole portfolio. You're just doing little bits of it to get it back into balance. And then on June 5th and June 8th, we did an opposite rebalance, because then the two funds that we mainly have that have those stocks in there were up about 50% at that point from the low of March 23rd, and we rebalanced the other way. And so it's very simple, takes a little bit extra work, but when the stocks had gone back up, now they're getting more risky again, and now you have a higher percentage because they've gone up in price, so now you're just taking a little bit out of the market at that point. And it's a beautiful thing. It's easy. And it helps people. And I work with people who are mainly delegators. I purposely don't want to bring on board a client that's a do-it-yourselfer because they'll just be too difficult to work with. So, they are real good about working with us, and we usually don't have to talk them into too many things.
And I actually work with a lot of do-it-yourselfers. I work with both. My business is structured where I am happy to charge a fee, either flat rate or hourly, for my time. And I would say about 20% of the people that hire me to devil's advocate for them and to help them build out the strategic plan. But they have every intention of continuing to manage their investments on their own, and that's okay. When we're building out the initial plan, one of the things I always look at is maybe areas that I see improvement in their portfolios. If they're too heavily weighted in international, I'm going to let them know. Or if they have some investments that are maybe off kilter, I'll bring that to their attention. But I can still build out the strategic plan, allowing clients to have that ability to make those investment decisions on their own. With that said, the other 80% of people who engage me don't want to do it on their own and prefer to have more professional investment advice. But I like to leave that up to the client to decide. I don't think that, for me personally, I don't want anybody to have to hand over their investments to me if it's something that they enjoy doing, that they're good at, and that they want to continue working with. But I think it's important for those people to even have somebody who they can bounce ideas off of and make sure that they're on the right track. I have clients who have built out their entire financial plan on their own, and they bring it to me and say, what did I miss? And I'm able to help them figure out what gaps did they not realize were as part of their plan. So if you're a do-it-yourselfer, that doesn't mean that you can't also get financial advice. It just means that, you have to find the right firm or the right advisor for that.
Yeah, I'm pretty much the same as Jackie. In fact, I'm bringing on one of my bigger clients tomorrow, as it turns out, who's in that latter category. I mean, he's been investing himself pretty much most of his life. He's very sophisticated, but yet he's aging, and he wants to have help make sure he's on the right track, number one. And then number two, have somebody help going forward. And then number three, something a lot of people forget about is, particularly in a married couple situation, he knows how to invest on his own, but as he ages, he doesn't want to do it as much because it's a lot of work in retirement. But more importantly, his spouse doesn't know how to do it. And so what a lot of people forget about is what happens if something happens to them and they're no longer around. What is their spouse going to do? So by having a planner or somebody that's a sounding board, like Jackie was talking about, I do the same thing with some of my clients. Having somebody just on a partial or a part-time basis to do that makes that transition a lot easier if that less sophisticated spouse, the more sophisticated spouse passes away, leaving the other person to figure out what the heck to do in that situation. So I'm gonna transition. I'm gonna give everybody a real quick snapshot of how our industry works, and I'm gonna let John and Jackie comment on this or add something to this if they want to. But I think most people don't know this. That's why I'm going to go through this real quick, and then I know we're running out of time, so I'll cut it off. We have in the financial services industry, if you want to hire somebody like the three of us on here, there's a lot of different names, criteria, designations, and so on. There's two fundamental approaches, though. There's independents and there's wirehouses. That's what we call them in the business. So a wirehouse is a national firm. Everybody that you would hire, all the advisors work for that wirehouse, like Wells Fargo advisors or like Merrill Lynch or like Edward Jones. If you're an independent, that means you have your own company. I think all three of us are independents, right? John and Jackie have their own company. WWM is an independent. We're what's called an RIA, Registered Independent Advisor. So the three of us are independents. When you're an independent, what that means is we don't have a big bank to worry about like Wells Fargo does, where they're pushing cross sales requirements on them or sales quotas or things like that. Merrill Lynch's sales quotas are pretty high. For example, we don't have all those things. We don't have somebody on Wall Street, overseeing our investment advice. We're doing that ourselves. We're in business as a small business owner, just like everybody on this call is. In other words, we lease our office space, we own our computer, we buy our software. We lease wholesale services from somebody like Charles Schwab or from somebody like LPL or somebody like Fidelity. Fidelity has a wholesale service. So we lease services and able to do our business. We're not employed, like I clear through Schwab. That doesn't mean I'm a Schwab employee. I am not. I'm an employee of WWM or affiliated with WWM Financial. But we custody through Schwab, which means if you come into my office and set up an account with me, it'll be a Schwab account. But it won't be the same as if you have a Schwab advisor on the retail side, because that's a different business. That's not my business. So I just want you to understand there's two different approaches in our business. There's the independent channel, there's the wirehouse channel. One's not necessarily fundamentally better than the other, although I would say independents naturally have less conflicts of interest than potentially on the wirehouse side, which I don't think I'm making that up just because I'm an independent. I think that's just a fact, number one. And then number two, there's different ways we can get paid. So I want Jackie and John to both comment on this one. You can comment on the previous one as well. But some of us, in the old days, the way you worked with your stockbroker is you called he or she on, 6 months ago, and they say, hey, I'll pick on Janny Jackson. So, hey, Janny, we should buy 100 shares of ABC, stock ABC. And then, 6 months goes by and I call you back and I say, hey, Janny, that ABC we bought, I think we should move on. It's not doing so well. Let's buy, XYZ. And so that advisor, that broker, stockbroker, he or she got paid with a commission, a sales charge for making those sales, both buying the initial positions and selling them, and again, buying the XYZ the second time. So they were commission compensated. Many of us today are not commission compensated. We charge a fee. My firm, for example, we generally charge an asset-based fee, which means if you have $100,000 and we're charging 1%, that fee would be $1,000 a year, which in reality, we charge $250 a month against your account to provide our management services to you. That's the way it works. Jackie, it sounds like, does a flat fee, which we can do also. But let me turn it over to John and Jackie and let them comment on all this. So I probably confused everybody.
Well, Jack referred to her flat fee, and that's a new emerging area that's very cool. We actually do a combination of both. We have some clients that are on a flat fee and some that are a combination. And in the 401k business, same thing. We have some flat fee, some asset-based fee. But, you know, back to the, by the way, it's registered investment advisor, not independent advisor, but same kind of.
Oh, you're right. You're right. Sorry.
But yeah, we're an RIA as well. And, but what's really tricky in the world of, you know, the wirehouses is that a lot of them do have an RIA license, but they also have the broker license. So when you're talking to them at any one time, you don't know which hat they have on. And we have the same problem in the 401k industry, but there's a parallel in the 401k industry. There's that same issue of the good guys, bad guys, so to speak, with, you know, accepting commissions versus a fee. But it is very complex. And then they get into multiple levels. For example, you know, there might be a section manager or a branch manager in a wirehouse. And if he can convinces a couple of his brokers to sell X number of annuities, then he and his family are going to get a trip to Bermuda or something like that. So there's just all these horrible tentacles that are built in there. And working with the small independent is so much better because each new client we bring on is a new boss for us. And each new client matters to us. And that's not the true in a wirehouse.
I know we're way over time, but one other quick note. In order to be a financial advisor, you can actually just have a high school degree and pass a test. So it's really important to know that when you're searching out a financial planner, I think the CFP marks are extremely important. Personally, those require an advisor to have at least 3 years in the business and to have a higher degree. You have to pass 6 upper division courses, take a test similar to the CPA or the bar exam in our industry. So it makes sure that your advisor knows what they're doing. It also requires them to be a fiduciary. And I think that one of the terms that is sort of missing from this conversation right now is fiduciary. Whether you're at a wirehouse or an independent, if you're acting as a fiduciary, then you're required by law to act in your client's best interest. The one thing that as they were mentioning commissions or some of the other ways people can get paid, I think that today versus seeing it as a stock sale, which is an older practice, used to be an issue. Today, there's a lot of life insurance being sold as the investment end all be all. Be very wary of that. Or when it comes to annuities or some of these insurance-based products, whether it be life insurance, a variable universal life, a universal life policy, or an annuity, those are the types of products that pay advisors a lot of money. They make anywhere from 5% to 10% on the amount that you contribute to that account in the year that you make it. And on life insurance, they make up to 100% of your first year premium. So if they convince you to put away $30,000 a year into this life insurance program, and that's going to be your retirement, it's going to be your life insurance, it's going to be everything, they're actually making somewhere close to $30,000 in that first year for selling that to you. Yeah. So it's a big red flag and something to be very careful of. When it comes to choosing an advisor, I think it's important to figure out what you need. Do you want a strategic plan? If so, and somebody says they're going to do it for you for free, they're not doing it for you for free. Nobody does work for free. So if they're not charging you for the plan they're providing, they're selling you something, or they're going to charge you in some other way. If somebody's charging you for a plan, like I do often, I'm basically saying, look, I have no ulterior motive. I want to make sure the advice I'm giving you is the advice you need. I'm not selling you anything. You're paying me for my time the same way that I would you. It's just important to understand how you're engaging somebody, why you're engaging them, what your intent is, and then to always just ask the advisor, how are you being paid? How are you paid on this? And if they can't answer that, or if they're skirting around the answer, I would not buy from them, or I would get a second opinion. If somebody asks, how do you get paid? I tell them, no problem. This is how I get paid. I charge 1% if I'm managing money, same as Scott. I charge a flat rate for my time if I'm advising you in that manner. There should be no dodging around how you're paid. And if there is, just end the relationship and move on.
Right on.
Cool.
And
So
on
really, really good stuff. Thank you, Jackie. Thank you, John. Appreciate everybody hanging in there, or a few of you hanging in there. We've overextended our warm welcome, so I'm going to cut it off with one exception. I'm going to give John and Jackie and myself a chance to, in 15 seconds, maybe 20, just any last parting advice for anybody on this call. Go ahead, John.
Well, I just wanted to share that I don't have a CFP myself, but I really like independence. So I have a separate independent CFP to whom I outsource, because I want to have more than one brain on the effort. And CFP is one of the good alphabet soups, but the insurance person that Jackie referred to, they're infamous for their alphabet soup. So if you see an insurance person with about 8 million credentials after their name, they're going to be the ones who get that $30,000 in the first year. So watch out for some of those credentials, but CFP is a good one.
And a lot of those credentials are like sitting in a webinar for 4 hours, and then you get the letters. So
Exactly.
You don't need much. Jackie.
And not all insurance people are bad, so I hope I didn't paint that picture incorrectly. Life insurance is necessary, but when it's the end all be all, that's when it's worth getting a second opinion. Just thanks for having us today. If any of you ever have any questions, feel free to shoot me an email or let me know. I'm happy to, give anybody 15 or 30 minutes of time to answer some questions. So certainly just let me know if there's anything I can help you with.
Yeah, for me, thank you both. And for me, it's just seek out advice if you need it. A lot of people feel comfortable making their own decisions, and that's fine. I would say honestly, one little quick story though is, before I got into business, I had a first career which happened to be satellite communications for me, but I did something else for quite a few years before I got into into financial planning. I thought I knew quite a bit because I read the Wall Street Journal and I read publications and I learned and I took some classes and so I thought I was pretty savvy in finance, and probably compared to a lot of people I was. But when I got into business, I learned more in a year than I knew in my prior 22 years in industry. So I would just say, honestly, if you need help, please seek it out, because we are as trained as a heart surgeon is to do heart surgery, or a CPA is to deal with your taxes, or anybody else that you might hire as a professional. People don't think of us that way a lot of times, but trust me, we know a lot because we focus on this every day of our lives. And if you get the right people, you will be more than rewarded, as John mentioned earlier. So thanks again, everybody. Thanks, panelists. And I'll turn it back over to John, and I think we're done.